Hello and welcome to Business Today Television. I am Siddharth Zarabi and my guest today is noted economist Dr. Arvind Panagariya, Professor of Economics at Columbia University. He was earlier the Vice Chairman of the NITI Aayog and in fact has recently now been appointed the Chancellor of Nalanda University. Dr. Panagariya, welcome to the show, and I want to begin by congratulating you on this latest appointment where I'm sure you will do very well to enhance that university, sir.
Thank you, Siddharth. A pleasure to be on the show. And let us hope we do need to build up Nalanda. There has been a good start in the last 4 or 5 years, but we have to take it much farther. Ultimately, if we can bring out half the glory that Nalanda enjoyed in ancient times, that will be quite satisfying.
We'll perhaps do a separate conversation in the future on that, but I want to begin today's state of the economy, the global and the Indian economy conversation with you by asking you about, you must have noticed that the WHO has in effect called the end of COVID. It says the COVID emergency is over. But what I want to ask you, Dr. Panagariya, is the global economic emergency over, or are we still in the woods?
I think this is something that rocked the economies of the major countries during the time that the crisis prevailed. We all in India as well as in the United States had sharp declines in the GDP, Europe as well, China too. So, it's a good thing. If WHO has now said that the emergency is over, that I think is a good sign. WHO takes a conservative approach to this. And so if it says that we no longer need to fear COVID, I think that's a good thing for the economy.
What's your own assessment of the state of the global economy at this point of time?
So I think it's a bit of mixed record right now because clearly the recovery has happened both in terms of GDP and employment numbers, both in Europe and the United States. The numbers on employment have remained robust, in spite of a lot of contraction reactions by the central banks and all on that front. But inflation scenario is still not over. It looks better. The inflation rate in the United States, had gone to about 9%, currently running at about 5%, but that's still too high for the United States. And the scenario in Europe is not terribly different along similar trend. So on inflation front, we still need to be careful. Then, in the manner in which we get impacted, there is also the issue of interest rate, which remains high. And I suspect, the interest rates will still rise a bit. And we can discuss a bit more, but there is a third sort of source of worry here also, which is the large fiscal deficits that have been persisting. Whether you look at the US economy, you look at the European economy, even China, the debt to GDP ratios have been very high. And over the longer run, particularly with high interest rates, there is something that can be a challenge down the road. So these are, and then, the other source of transmission, negative transmission for India is the oil price. So those are the 3 or 4 factors which we need to consider. I mean, my sort of view still remains cautiously optimistic as long as we don't make mistakes, in terms of running our macro. I think we'll be okay. But these are the areas in which we have to worry a bit, particularly the interest rate. I think to me is interest rates in Europe and the United States. because that is what ultimately determines how capital is going to flow in and out. And that's what we need to be cognizant of.
That's an important point, and I'll come back to that point subsequently. But for the benefit of the lay viewer, the trade war, Dr. Panagariya, of sorts that started between the United States and China in 2018, that impacted global growth. Then came COVID, then Ukraine, and then this unprecedented increase in inflation, which has rocked the entire world. Since you spoke about inflation, is that going to be the sort of long-lasting, lingering effect of all the disruptions that we have seen over the last 3, 4, 5 years, Dr. Panagariya?
Yeah, good point. So you saw that I'm a trade economist, and the point on trade was conspicuously perhaps missing from what I said, but that was deliberate actually. Trade side worries me a lot less. There was certainly a bit of supply chain disruption, and that did contribute to inflation. But that's largely behind us, because if you look at symptoms like trade war, the disruption of wheat supplies from Ukraine, things like that, it looks like things are bad. But if you look at the aggregate, what is happening to trade, it's quite remarkable, how trade has recovered. The peak prior to COVID, which was in 2018, for merchandise exports was something like 19 trillion. For services, it was over 6 trillion that same year, so total of over 25 trillion. And today, trade has recovered fully. The 2021 figures were 22 trillion for merchandise exports, and 22 was even higher. So, about 22, perhaps, if I'm not mistaken, had hit about 25 trillion. So trade has recovered no matter what. I don't like the fact that there is this trade war going on. There is also this kind of resurgence of protectionism in virtually all economies: Europe, United States, China, India. All around you see this protectionist trend. Nevertheless, somehow trade is moving ahead quite robustly. So at least at the aggregate level, now specific sectors may be impacted, but at the aggregate level, it's quite remarkable. It has come back. So to me, again, from India's point of view, when we come back to talk about it, what I worry about is what we do internally to get a larger slice of the global trade than we currently have. But the overall size of the pie, I don't think is a big challenge as far as trade side is concerned.
Since we are talking about global trade, the China overhang on the global economy has been pronounced. We have now seen a change in stance by the Chinese authorities. I wonder if you have an assessment on what kind of role is China expected to play as far as global trade and the economic impact of that is going to be in the near future.
So there's no doubt, if one takes 5 to 10 years time horizon, that reconfiguration of trade flows is going to happen. The importance of China in the global economy has so far held up. Their share of about 12 to 13% in merchandise exports has held up. But I think that part is going to change, meaning that, we will see internally, partly, of course, the impact of wages that is ongoing has nothing to do with any of the policies. It's simply that China is way richer now. And that is going to cut out some of the exports of China, whether it's to the United States, India, or Europe. Now, what comes to fill it? Is it going to mean that overall trade would decline as a result, or is it going to mean that other countries, such as India, will come to fill the gap? Remains to be seen. My sense is that it'll come out somewhere in the middle. That the expansion of trade might slow down a little, but not as much as perhaps the exports of China will decline. Because other countries, even some of the smaller countries like Bangladesh and Vietnam and so forth have been coming in to fill some of that gap. And India, of course, is the big country there, which is, I mean, we are also beginning to pick up now on our exports. So we'll perhaps fill some of that gap as well. So not a big impact on the countries, but some reconfiguration is going to happen.
Reconfiguration is going to happen. That's a good point there. Let me come to the United States once again, and this is to do with some of the worries that we spoke about at the beginning of our conversation. The stress at US regional banks, and there have been worries with a European bank as well, and the fears of a financial contagion. How real is that a risk, Dr. Panagariya? Is there a 2008 sort of moment waiting to happen, or are these fears overblown?
No, I don't think we are going to see a repeat of 2008. That was a very severe shock. Luckily, in this case, this originated in the regional banks, and at least it began in a single bank, which really could alert the Fed Reserve and the Treasury in the United States to the potential problems. So some of the preventive measures have already been put in place. Some are under discussion. We might still see episodes here and there. But ultimately, remember, the big difference from 2008 is that it is the large banks that got into trouble. Lehman was very, very large. And then there were other large financial entities as well, some of the insurance companies and all, which got into trouble. That is not the case here. The pressure here is a lot more on the smaller and regional banks, but the biggest four banks, they are quite sound, and they are not subject to this kind of problem that the smaller banks are. So for the United States internally, I think a bit of challenge, no doubt, but I don't see that it's going to spill over out of the United States. Now, similar stuff is going on in Europe as well, because the rising interest rates are impacting the balance sheets of banks around the world. And we are less impacted in this sense, but Europe and the United States particularly are. So we'll see, but these will be localized. I don't see, this is falling, this is spilling over to the global economy.
One of the spillovers, Dr. Panagariya, has been on consequence of inflation. And if you look at the data, it's very clear that inflation is still 3 to 4 times of target across the globe, especially in the developed world. What is your sense? Is the inflation issue being handled to some extent in the US due to this monetary tightening, and is there some more runway left for the US Fed to keep tightening?
Yeah, see, on the monetary side, I think the Fed Reserve has moved in now. It was a little bit behind the curve, but it has now moved in, and the interest rates have gone to about 5.25% from nearly 0%. So it's a very large increase, and I don't think Fed has any intention of coming to a full stop yet. I don't think it will. It is running at 5%, but the challenge for the Fed now, in the wake of this Silicon Valley Bank going belly up, has been that ultimately what it does to interest rates also does something to the financial stability of the financial system. And that I think has become the issue of the trade-offs. But I agree with you that in the US it's not so, not 3 to 4 times. I mean, it's about running currently at 5%, which is 2.5 times the target of 2%. So it looks better, but still not comfortable enough. Where I think the action is required, and I see no awareness or no willingness actually to see it that way, is the fiscal side of the United States. The spending by the Treasury is just out of hands. And this is where I had said, that the debt to GDP ratio is now becomes a very big challenge, because now, when the interest rates rise up to 5.25%, servicing the debt becomes extremely costly. And so, if you are going to particularly borrow more, all right, previous debt may already have been borrowed at lower interest rates, and therefore, maybe payments on that will not rise. But when you borrow more to run more fiscal deficits, then there is a serious issue of raising it at a very high cost, and that I think is a bigger challenge. So really, and this is a problem not just the United States. I think this fiscal being out of hand is also a problem in Europe, largely. High debt to GDP ratio continuing, and larger fiscal deficits continuing. Even you are seeing, China had to recently bail out one of the provinces, or is in the process of bailing out one of the provinces on its debt default. So this is, I think, this is in the intermediate run, this is where the bigger challenge is.
Even if the Fed were to stop raising rates, do you think financial conditions are likely to ease anytime soon? Because you touched upon this point briefly, and from a point of view of India, this is very, very important because capital flows have had a significant impact, and the reversal has also had an impact. So do you see financial conditions easing anytime soon?
Yeah, so this is where, I was referring to the interest rate in particular, that as the interest rates keep rising in the United States, all capital moves into the debt, meaning treasury and treasury bonds and so forth. And that, of course, on the one hand also impacts the US stock market. All the stock markets have been down largely. But for the emerging markets, that creates a huge problem, because, for the United States itself, it's not a big deal. Whatever capital flows out of these emerging markets is, for the US, is not it's a drop in the ocean kind of situation. But from the viewpoint of the emerging markets, these are very large amounts, proportionate to their GDP. And this is where the challenge emerges. So I think that's something that the Reserve Bank of India will have to continue to deal with. I believe that the worst is over. I don't think, we are in the kind of situation that we were when interest rates just began to rise and massively capital flowed out. I don't think that there is going to be a repeat of that anytime soon. But overall scarcity will remain, which from India's point of view means that, we need to, in a way, handle our own macro very deftly, because, you can escape this. Because even if the overall total flows decline, if your own macro is superior to anybody else's, then proportionately the capital will have the tendency to come to you. So less will go to China, less will go to some of the other parts of the world. So even with absolute declines in the capital flows around the world, the country that runs its macros deftly and continues to promise good returns in the future will possibly escape it.
Absolutely, and that brings me to the India sort of focus. The balance sheet issues that we had at one point, Dr. Panagariya, and that had an impact across lenders and borrowers, are broadly behind us. There may be some company specific stress, but that's a micro matter really. And like you said, the monetary and fiscal stimulus, at least by analysis post-COVID have been responsible. How would you
Yes.
describe India's state of the economy at this point of time?
Yes. No, I remain upbeat. I have been upbeat and I remain upbeat precisely because, I'll say macro, we have handled incredibly well. All congratulations to both the finance and the Reserve Bank. Through COVID, etc., all kinds of pressures came to print more money and all. We avoided that, and we are reaping the fruits of what we did well. We have to stay course on that front. There is no question. My worry, and overall, I think, GDP growth this year, we are ending with 7%, maybe 7.1%. And I think we'll continue roughly on that path in the years to come. My sort of worry in India actually remains on micro side. I think, macro, we have always, even when you go back to the license permit Raj era and all, broadly, except for small episodes or, short episodes of irresponsible behavior, which, had led to the 1991 crisis, also balance payments crisis. We always ran macro very conservatively, very responsibly. Where we have done very badly is the micro. Now we started improving this micro side of it, and we've been doing that. But I think we need to do a bit more. For example, the labor laws which were actually passed, in 2019, we still have not been able to implement those. So obviously, because not within a year there's going to be an election, so there is no major action on that front is likely to happen. But I hope, post 2024 election, we return to many of the micro reforms that are still kind of to happen. Land markets really remain as distorted as they were around the time that the UPA left the office. And they had actually left the land market more distorted than it was prior to that in the wake of this 2013 Land Acquisition Act. So I think we need to return to some of these micro reforms. On trade, we have actually gone back a bit. So that should also be on the agenda post 2024. All the free trade agreements that are pending as well with the UK, I thought it was almost done, and we still are not actually done. European Union and all. So a lot of this agenda, which I sort of classify under micro reforms, I think we still need to do, because our potential is 9-10% over the next 2 decades, and we can't let that potential go to waste.
Dr. Panagariya, what is your own assessment of this government, Prime Minister Narendra Modi's investment as far as the reform part is concerned? And I'm glad you made the mention of micro reforms, because some of the big ticket items have been done. It's now the really careful, painstaking work that has to be done on multiple fronts. Has this government been able to invest the same kind of political capital that it has done on other issues on some of these reform areas? You mentioned labor, for example, and you also said quite correctly that we'll now have to wait for a year plus for any major action.
So as far as the record up to this point is concerned, absolutely. Modi government has done as well or better than any other government in the past. I used to say Vajpayee government and Narasimha Rao government did the big sort of reforms, but Modi government has done very well as well. And mind you that some of the reforms that Modi government did were the most difficult reforms. We always backload the tough reforms. So whether it's bankruptcy code, I'd been writing for more than 15 years. That got done. GST got done. One of the things that I had certainly not foreseen myself, which is the digital infrastructure. It is a marvel to watch, which of course, has really revolutionized all the social programs. Delivery of social programs became so effective. Beneficiaries actually are receiving pretty much, close to 100% of their entitlements. So that then also passing labor laws from the parliament, at least, remains to be implemented. But the more difficult part has been accomplished, actually, because now no legislation has to be done. It's simply that rules and regulations have to be written by all the states, and there are a couple of lagging states which are holding up the implementation. In this case, there's some peculiarities. Because of certain peculiarities, you cannot implement these codes, in at 90% of the states. You have to do it for the 100%, because when you implement these 4 codes, all the old 30 laws get repealed automatically, and therefore you cannot do it in 90% of the states and not in the remaining 10. So that is what has been holding it up. But that was a very big, major reform. So, absolutely done very well, but we are not done. We still have to keep at it when in 2024 the government comes back. I'm certainly upbeat that on the record alone, the Prime Minister will come back in 2024, and very much hope that we resume the reforms. I mean, my favorite area also is still remaining higher education. I think we have not even done on certain things like autonomy to the colleges. We have seemed to have actually gone back because recently the Education Ministry revised the rules and regulations for the autonomous colleges and autonomy to them, and they actually take away some of the more liberal provisions that had been put in place earlier. So quite a bit to be done still, but quite a lot has been accomplished in the last 10 years.
Since you mentioned about what needs to be done, and that's still on the pending list, at the current rate, Dr. Panagariya, and I'm referring to your earlier mention of our potential growth, by when do you expect we would grow closer to the 8-9%, nearer to 9% kind of trajectory?
Look, if we implement first the labor laws, we do something on land. That needs to be done. Land is incredibly expensive in India, and that is the result of policies. Not, it's a longer discussion, but we need to do something on land. We do that, and then some bit of privatization that has been on the agenda. I think that will suffice. If we can simply, some bit also on taxes, which is not so much the central problem, but somehow the local problem. From the smaller entrepreneurs, I hear this a lot. The larger entrepreneurs manage to kind of deal with the tax system, but the smaller ones, complain quite a bit, actually, that tax harassment goes on, and that drives the smaller businesses out. You may have seen there was a story done by the Economist magazine, how, a lot of the businesses have moved to Dubai and all. That sort of thing should not be happening. I mean, even occasionally I meet here in New York City, some people who have been running businesses in India, and they said, we just have had it with the tax harassment, and so we are just thinking of moving to the United States or elsewhere. So I think that needs to be paid attention to. But I think we are at the cusp. We are almost there. Internationally, by the way, now finally there does seem to be some bit of breakthrough that that the multinationals which had been invested in China and were looking for alternative locations now seem to be coming to India. I think finally it looks to me that we do have a breakthrough there. With some of these major kind of multinationals making their decisions, particularly Apple, this was very visible. And that, I think, if we can capitalize on that, and a few more multinationals, this kind of, iPhone-like breakthroughs happen, I think we get very quickly to at least the 8% range, and then we can build on that.
You think we are still missing something for making sure that China plus one actually becomes a full-fledged reality?
Well, you see, I mean, we have recently seen it. I've seen at least the reports. I don't know how true they are, like on labor laws, for example, that, even on running the shifts, 12-hour shifts and allowing women to night shifts. A developing country has to allow these things. Without it, how do you expect? So multinationals have to. The global marketplace is incredibly competitive, and so they have to have that kind of environment. So, that's clearly to me something within our reach. We have passed the laws, but at least according to some of the news that I've seen recently, Chennai had sort of promised to do this shift, 12-hour shifts, permitting 12-hour shifts, and now apparently the labor unions seem to be opposing that, and it seems Tamil Nadu will go back on that. So that sort of thing we can't afford, to make a success of it. We got to. And particularly remember that, most of these enterprises are going to come to the coastal states. So one needs the coastal states to be particularly on the frontier of this. Because rightly the multinationals are coming in not for the domestic market, no matter how we try to think ourselves that, we are such a huge market, 3.5 trillion and all. But the fact is that the global marketplace is, more than 10 times of that. And what multinationals are looking at is the global marketplace. And therefore, for them, the location on the coast is very important. And this is where I think, the coastal states really have to be on the frontier of it. They have to be on the frontier of reforms. And where, the consensus is not there, if they would talk to take into confidence the labor unions and whoever the other impacted parties are, I think they can be persuaded. I think it just requires some bit of dialogue, careful explaining that it is good for everybody. When the economy grows from 7% to, particularly in particular states, from 7 you can go to 10%, 11%. Particular states, the country as a whole is harder to carry on at 10, but specific states can certainly do that very easily, grow at 10%. And when that happens, everybody benefits. It is not, employment. Ultimately, who is the beneficiary of increased employment? It is the workers, whom the unions represent. So some bit of dialogue, perhaps, concerted effort, persuasion, etc., is required. But I personally think that, as far as the willingness of the multinationals themselves to come to India is concerned, I think we are on the cusp of it. There does seem to be a breakthrough.
Okay. Dr. Panagariya, the very last question for today's conversation, and this is to you, having sort of worn so many different hats and also interacting with a lot of opinion all across the world. If you were talking to a foreign investor, an American investor, or anywhere else in the world, and he asked you to describe India and the opportunity or challenges that it represents for such an investor, what would you have to say to him?
Well, opportunities are simply enormous. It is a country with only about $2,300 per capita per annum income. And a very large country, 1.4 billion, going to 1.64 billion, a young labor force. There is not another country like that on the planet which can offer, and also talented people. I mean, even if our education system, etc., may be broken, out of 1.4 billion people, we produce a very large number, absolute number of very, very talented people. So there, I think it offers a huge opportunities on the opportunity side, and a country which has a government which is very forward-looking, which wants to take the country forward at a fast pace, which has demonstrated it by virtue of its own building up of the infrastructure in recent years, unprecedented growth of infrastructure all around, and so things are only going to get better and faster. So all those are the big positives. On the negative side, yes, some pain points, particularly at the entrance. When you initially start out, there are pain points. But particularly the larger multinationals can afford to overcome those pain points. Take examples of others who Samsung and other multinationals that have been operating, Amazon, whatnot. A long history now. So there are some pain points, but it is worthwhile, for any major multinational. It is worthwhile to deal with those main points, and ultimately, as multinationals enter the market, they themselves become internal players for liberalization, and so they also hold that kind of prospect. It's a democratic country, so they will not face China-like backlash in India ever. Again, small irritants will happen because those also come with the democracy. But look at the entire package, and I don't think there is anything like what India offers anywhere else in another country. I mean, Vietnam is where a lot of these multinationals have been going, but in the end, it's a 90 million people country. And labor is going to become scarce and land is going to become scarce, and so only you can go only so far. And it also, like China, is an authoritarian country. So what will happen tomorrow, you do not know. But India is very predictable as a democracy. So I think that would be my pitch.
Dr. Panagariya, since you spoke about population, I have to ask this very quick point as far as population is concerned. We've heard the headlines there, and it's very clear that we not only have the largest population but also the largest population of a certain demographic age profile. Is that something that worries you, or do you think there is still scope in the demographic dividend theory that we have heard for so many years?
Oh, I think that's it. These fears being raised, I do not understand. There are two questions here: composition of the population, age group composition, and the size. So as far as composition is concerned, won't you want a younger rather than older population? What does younger population offer you? Larger workforce, and since they are working, the younger generation saves, whereas older one largely spends. It dissaves, right? So the younger population means both larger supply of labor as well as larger volume of savings. And of course, younger population is also participant in all kind of innovations that happen. So composition-wise, the only downside people sometimes point out is unemployment. But unemployment doesn't depend on the composition of the workforce. It depends on your policies, and we know that in India, our employment rate has been, largely 3 to 5% at the most. That's the widest possible range. There was one year when it went to 6, but that's unusual. The problem we have in terms of this composition is that the productivity per worker. So problem is not unemployment but underemployment. Underemployment meaning low productivity per worker. Now this has been rising. Productivity per worker is no question. Post-reform era, it's been rising, but it needs to be accelerated further. There is no doubt, and we talked about the reforms, etc., that need to be done for that. But certainly remember, our productivity per worker when population became younger, it did not decline; it only went up. So at least correlation wise, you cannot pin anything on the younger composition of the workforce. The other part of it is the size, and again, size actually offers lots of advantages. I mean, I'll just use one example, which is the digital platform. Right? Once you create the digital platform, it's available to everybody. You can add another user to it. Cost doesn't go up. So per unit cost of provision of the digital infrastructure declines progressively with the size. How many people join in. That is on the cost side. On the benefit side, look at that, when more people actually join the digital infrastructure, its utility to each user increases, right? And if there are only 10 other people who are on the platform, I can interact, I can do transactions only with those 10. But if there are a million, then I can transact with a million different people, my opportunities rise, and also both on the cost and benefit side, size offers enormous big advantages. And that argument applies to all other infrastructure. You build a road, it's there for everybody else to use. Not only then the network also, you build a highway, the utility of highway begins to rise as you connect more and more villages around it through connecting roads, the last mile connectivity. So size also generally offers you a bigger advantage. Where I think it has disadvantaged us is the fixity of land. Land is fixed, and we have too many people in agriculture. So the land holdings have become smaller and smaller over time, which is, of course, also translates into lower productivity, ceteris paribus, the things held constant, per worker. And that is a problem, of course, which we need to solve, because 45% of the workforce should not be in agriculture. An economy that is on the go for 8 or 9% growth needs to pull these workers out of agriculture into industry and services. That is an ongoing process. That's something we need to focus on, regardless, whether our workforce becomes even larger or not is not an issue. Even in the current scenario, it is essential for us to move these workers out of a large part of this workforce out of agriculture into industry and services. I think that other than that, neither size nor the younger composition is to be scoffed at. It is to be welcomed. So I personally see this absolutely no contest. In terms of arguments on whether this is a good or bad. It to me, or when even taking into account some of the negatives I pointed out, the positives far outweigh. And by the way, our influence in the global economy would also be in the next 20-30 years going to be that much more magnified, because who else is going to provide the workforce to the rest of the global economy? Not China, not Europe, not the United States. They're all going to need more workers. We are the only ones actually who are in a position to provide more workers. It's not an accident that so many Indians now are all over the globe today. This is a phenomenon which has, manifested itself in the last 20-25 years around the globe. But, no matter how anti-immigrant a country gets and all, you would see that the demand pull is so strong because of the aging population. Look at even a country like Japan, which used to be so closed, is now feeling that there's no alternative. So some gradual opening up even in Japan has happened already, and is going to perhaps continue. So whereas in the countries that are more welcoming, such as the United States, particularly Canada, Australia, I think Indian workers will migrate gradually to these areas, and that would only make India more influential globally.
Absolutely, one couldn't agree with that assessment more, Dr. Panagariya. I'm going to thank you for your time with us today and for giving us that very detailed overview about a host of issues. Once again, thank you very much for your time. With that, it's a wrap on this conversation. If you've been, thank you very much for watching. We'll be back with more. Do stay tuned in. Bye-bye.
If you like the video, do like, comment, share and subscribe.